How's it going, everybody? It's Stas here. So I want to break down a stock which, like you guys saw in the title, it has completely collapsed over the past couple of months. The stock has gone from $104, now it's under $60 per share, and it's down about 45%. And you guys can see the stock is none other than Activision Blizzard, ticker symbol ATVI. And in this video, we're going to break it down. We're going to talk about some fundamentals, we'll look at some financials, we'll break down the most recent earnings presentation, and of course, I want to go over some charts, what I'm doing with the stock, plus more. So sit back, relax, hit the like button, subscribe, check out my Patreon if you guys want all my moves in the markets, and you guys could also get 50 free bucks from M1 Finance and 2 stocks from Webull up to $1,600. All of those are linked down below, and with that being said, let's get into it. So like I said, this stock is down from $104. That was back in February, so about 10 months ago. Now it's sitting at 58 bucks per share, and it's down about 0.5% on the day that I'm filming this video. And overall, on the 3-year chart, which is what we're looking at right here, we're approaching, and literally we're seeing support right now at this point, we're approaching the uptrending trend line, where if the uptrend were to continue, this is where we would hold, right around 55 to 60 bucks per share. And we're actually seeing a bit of support there. The past couple of days, we've actually bottomed at about 55. Now we're starting to make a move back up to 60. So that's a very good sign that we are seeing buyers step in at that 3-year trend line support. And on the 20-day chart, what we're noticing here is we're struggling between the 50 and the 180 moving averages. We're kind of sandwiched in between those. So for this reversal, or rather for the uptrend to really continue here on that 3-year chart, we're going to have to break the moving averages on the hourly chart, the 20-day chart, which is why I always talk about on my YouTube channel, guys, when you're doing technical analysis, you must look at multiple time frames to make your decision. So overall, the chart looks pretty good. We're waiting on reversal. And if you look at the max chart, which shows many years of data, you guys can see how big this pullback actually is. And as of now, this company, right, you guys know it deals with games, gaming, electronic gaming, all that good stuff, media. They're a $46 billion market cap right now when I'm filming this video, and the PE, the price to earnings ratio, is 17 and a half. So this is, I'm not going to lie, guys, it's a pretty good valuation here if you're looking straight off of the PE ratio. I mean, the S&P 500 right now, the PE is about a 26, 27, something like that. Pretty frothy. So this is less expensive than the overall market. And don't get it twisted. You might think, oh, Activision doesn't have much growth. It has some growth, guys. And I think it's going to continue growing, and we will break that down in a second here. So 17 PE, this is opening up as a pretty nice value play. They also pay about a 0.8% dividend yield as of now, and they're split up into 3 segments. So you may think Activision, oh, they only do Call of Duty, right? Wrong. You are wrong on that. They do a lot. We'll talk about that too in about a minute from now. They do 3 segments. They're split into 3 segments: Activision Publishing, Blizzard Entertainment, and King Digital Entertainment. So now that we talked about those 3 segments, let's see what is in those 3 segments. So bear with me here, guys. I'm going to change over my screen here to the Safari tab, and we'll take a look at their most recent earnings presentation, which came out recently. And another thing worth mentioning is, I just thought about it now, there has been a lot of problems within the company itself, you know, inside of the organization, the culture, the management, stuff like that. I don't think it's a huge management problem. It's more like just a culture problem in general. I guess that does kind of, come from the management, I guess you could say. But this has been causing a lot of drama within the company. The stock's been going down because of this, right? It's a big part of why it's been going down. So overall, they are trying to fix the culture within the business, which I think will take time, and ultimately I think it will get better. But other than that, they've been doing pretty decent. You know, they've been executing decently. I mean, of course, they can do better. There's a lot of complaints about the new Call of Duty. We're not going to get into that, but overall, they are executing against their 3 strategic pillars: expand audience, reach, deepen engagement, and increase player investment. So obviously these days when you're playing video games, the idea from Activision's perspective is we want players in these games and we want them to be spending money in the game. Microtransactions, that's what they're known. That's what they're called in the video game sphere, right? You have Call of Duty, Diablo, Overwatch, World of Warcraft, right? Candy Crush. And if I go down a bit here, we can see the different segments, right? Activision. We have Activision Publishing. This is the Call of Duty ecosystem. There's a lot of different, obviously, Call of Duties, right? Their reach in this space is huge. They have Call of Duty. Monthly active users in Call of Duty franchise were consistent year over year on console and PC. They have Black Ops Cold War, Warzone, which I personally love Warzone. If it comes to Call of Duty, guys, I'm not a big multiplayer guy anymore. I used to be years and years ago when I was, in high school. But nowadays when I play Call of Duty, I just play Warzone, and they're crushing it on Warzone, microtransactions, all that good stuff. Vanguard is the one that just came out. Not the best from what I've been hearing. I did play the beta. I thought it was okay. I didn't buy the game. I'm not planning on buying it, but overall, not the best, but still, Warzone is dominating the category here. Then we have Blizzard. The Blizzard segment revenue grew 20% year over year, as you guys can see up here, driven by the successful launch of Diablo 2, Resurrected, and Blizzard had 26 million monthly active users in the quarter, and you guys can see they have the different Diablo games. They have Overwatch, World of Warcraft, which is huge. They have Hearthstone, which admittedly I've never played any of these games, but from what I'm seeing, the growth is there. It's pretty solid, and they're doing decent. And the biggest category, believe it or not, I think this makes even more money than Call of Duty from what I saw. It's the King segment. Their revenue grew 22% year over year to a new monthly quarterly record with very strong year over year trends for both in-app purchases and advertising. Do you guys know, before we even talk about that, King had 245 million monthly active users in the third quarter. And do you guys know these games? You probably do. Candy Crush, I used to play that a lot. Don't anymore, but you guys might still play it. Candy Crush is a big one. Farm Heroes is a big one. King is a big one. King's advertising business grew robustly with quarterly revenue growing sequentially and year over year to a new high. So if you think all Activision Blizzard does is Call of Duty, you are mistaken, guys. They have a lot of different games under their belt, a lot of different segments. And if we take a look here at the quick FS before we look at the balance sheet, actually, no, before we even do that, let's take a look. This is important. Let's take a look at the Q3 segment net revenue between all these. Yeah, look at that. King made more money net revenue than Activision did. So the mobile apps, they make a lot of money, very high operating margin. They made $652 million in the quarter. King, that is. Activision made $641 million in the quarter. And then we had Blizzard at $493 million, and all of them are about 35 to 45% operating margin. So that's pretty good, guys. I'm not going to lie. These businesses make a lot of money, and there is a bit of, short-term problems right now, like I mentioned, with the culture, problems within the culture, which I think it takes time. It's not going to fix tomorrow, but ultimately they're working at it. They've talked about it. They're working on it, and I think it will ultimately be resolved. So let's look at quickly this QuickFS website where we do see, the growth of the business, top line, bottom line, all that good stuff. And look at this. Remember in the beginning of the video, I mentioned how their PE is about a 17.5. That's pretty good considering they're growing the business about, sometimes year over year, sure, they're not growing. We've seen some years they've lost 5% revenue year over year, some 3%, but that was just 1 or 2 one-off years. 2019, they also struggled a bit. So 3 years out of the last 10, they've lost money. or they've shrunk revenue year over year. But for the most part, they're growing between 5, 7, 8% on a lower year. A good year, their best year was in 2016. They grew 41% revenue. And just in 2020, they did 24% revenue growth. So we're seeing revenue growth. I mean, in 2020, they did $8 billion in revenue. 2011 they did 4.7 billion in revenue. So they're growing over the last 10 years, and the P is too low, in my opinion, for the amount of growth they're seeing right now. And if I pull up the Yahoo Finance app right here, it's not the website, it's not an app. I guess you can say it's an app. I don't know. But what we're seeing here is total assets. Pay attention to this. When I look at businesses to invest in, I want to look at assets, liabilities, debt, all that good stuff, right? So total assets right now are sitting at about $23 billion. Total liabilities are $8 billion. So that's good. More assets than liabilities. And if we dig a little bit deeper here, we want to see current assets versus current liabilities. That's also known as the current ratio. Let me give you guys a quick definition here. I have it in my notes. Current assets, current liabilities. So current liabilities are essentially a company's short-term financial obligations that are due within 1 year. So current liabilities. Current means within 1 year. Current assets are all the assets of a company that are expected to be sold or used as a result of standard business operations over the next year. So you want to see current assets a lot higher than current liabilities. In other words, they can use their money right now to cover all of their liabilities that are due within the next 12 months, essentially is what that is. So in this case, current assets are $10 billion. And another thing, we'll talk about this in a second. Hold on. Current assets, $10 billion, $10.5 billion. Current liabilities, $3.1 billion. That's great. A lot of assets compared to liabilities. And if we look at cash, they literally have enough cash equivalents, and short-term investments. These are very liquid investments that they can just cash out. They have $8.6 billion in cash equivalents, and short-term investments. $8.6 billion. If they wanted to, they can pay off all of their current liabilities right now with that $8 billion in cash and short-term investments. It's that simple. So if you're looking at the balance sheet of Activision Blizzard, I think it's pretty solid from at least what we just saw. So overall, we talked about the business, right? At least as much as we can in a little 10-15 minute YouTube video, right? So what am I doing, guys? I bought more Activision, right? I didn't buy more because I didn't own it. I initiated a position in Activision at $58.80. And this is a longer-term position for me. I plan on holding it for a couple of years. And when we're in a market where we're super frothy, like we are right now, let's be honest, the markets are doing very well. The S&P's running. When we're in a market like this, it is difficult to find stocks that are decent values. And it's difficult. And in my opinion, Activision is one of those now. It's gotten to a point where the valuation is strong. It's decent, and they're still doing well. Sure, there's some short-term hurdles like there are with a lot of companies, but if you have faith in companies, when there are short-term hurdles, the stock's getting killed, that is when you want to jump in and buy in. So I like it. I like the growth. I like the games, the segments. I think they're going to do well. The balance sheet's strong, and I'm willing to put some money into this, and I will continue buying if it falls mid-50s, low 50s, all day, every day. I will be buying that. So what do you guys think? That's pretty much it. Let me know your thoughts down below in the comments. Hit the like button, subscribe. And again, I'd love to know your thoughts. And check out my Patreon. If you guys want all my real-time buys, sells, call-outs, morning update videos, plus more, I post all that on Patreon, putting a lot of work on there, and you guys get more access to me throughout the day, so check it out. Link down below, or you can go to StockSurfest.com/Patreon. Make sure to also get your 2 stocks from Webull and your $50 free from M1 Finance. All of that, again, is linked down below. I'll catch you guys in the next video. Thanks for watching again. As always, keep crushing the market. Stay safe out there. Let me know your thoughts on this stock. Peace out.